Ever watched a heist movie and wondered, what are those papers they're stealing? In Heat, Robert De Niro and his crew aren't just taking cash, they're after bonds. But what makes bonds so valuable? And why should you care about them as an investor? Well, today, we're cutting through the noise and getting straight to why bonds might be the most underrated investment out there. If you're building wealth, whether for stability or growth, you need to understand bonds. 1. What are bonds and how do they work? When you buy a bond, you're lending money to a government, corporation, or organization. In return, they pay you interest, usually in regular intervals, and give you back the original amount, called the principal, at the end of a set period. Think of it like this. You lend your friend $1,000, and they promise to pay you $50 a year for 5 years. At the end of 5 years, they give you back the $1,000. Simple, right? That's how bonds work, just on a bigger scale. The big players use bonds to keep cash flowing, and smart investors use them to make money off the game instead of being played by it. 2. Counterparty risk. Now, just like lending money to a friend, there's always a risk they won't pay you back. That's called counterparty risk. Government bonds from stable countries, low risk. Corporate bonds from solid companies, moderate risk. Junk bonds from struggling companies, high risk but with higher potential rewards. If a company or government defaults, you might not get your money back, so choosing wisely is crucial. It's the difference between lending to a reliable businessman and a guy who swears he's just one bet away from making it big. More videos will be made on this topic in the future. Make sure to subscribe so you do not miss them. 3. Long-term versus short-term bonds. Bonds come in different maturities. Short-term bonds last a few months to a few years. Long-term bonds can last 10, 20, even 30 years. Short-term bonds are more stable and less sensitive to interest rate changes. Long-term bonds offer higher yields, but can fluctuate in value when interest rates change. If rates go up, existing bonds with lower rates lose value in the market. But here's the kicker. If rates drop, long-term bonds can spike in value, creating serious upside for those who got in early. 4. Liquidity and cash management. Short-term government bonds, like Treasury notes, are highly liquid and often considered cash investments. They can be quickly sold in the market with minimal price fluctuation, making them a great place to park money temporarily. These are particularly useful when you're stacking up cash on the side, waiting for the next market downturn to deploy your capital. Instead of letting cash sit idle in a bank account, Treasury notes let you earn a return while maintaining easy access to your funds. 5. Holding period and capital safety. You have two choices when you buy a bond. Hold it to maturity or sell it early. Holding to maturity means you get the full amount promised, no surprises. As long as the issuer doesn't default, your capital is safe, and you receive all interest payments as scheduled. This makes bonds a reliable option for preserving capital, especially for risk-averse investors. Selling early means you might sell for a profit or loss, depending on where interest rates are. Here's why it matters. Bonds have two ways of making money: yield, your interest payments, and worst price movement. Some investors buy bonds for cash flow, while others trade them like stocks for capital gains. Understanding both is key. 6. Defensive versus high yield. High-yield bonds can serve different roles in a portfolio. Defensive investors use government and investment-grade corporate bonds for stability. These are reliable, low risk, and pay steady interest. On the other hand, if you're chasing higher returns, high yield or junk bonds offer bigger payouts but come with more risk. They sit in the more aggressive, growth-focused part of a portfolio. 7. Lower risk. Here's another key advantage of bonds. When things go wrong, debt gets paid before equity. If a company goes bankrupt, bondholders get their money back first, while stock investors are often left with nothing. Owning bonds means you're on the lender's side, not the investor's side. Stocks give you ownership, but bonds put you in the creditor's seat, offering more security when markets take a hit. That's why, even during economic downturns, bonds can be a safer place to store wealth. 8. Diversification and income generation. Bonds aren't just about safety, they're also a powerful diversification tool. When stock markets crash, bonds can hold steady or even increase in value. That's why they're often used to balance risk in a portfolio. On top of that, bonds generate consistent income. Even during recessions or bear markets, bondholders continue to receive interest payments. This means you could reinvest that income, giving you more firepower to dollar-cost average into stocks when prices are low. Instead of sitting on the sidelines during a downturn, bonds help you stay in the game, steadily growing your portfolio over time. 9. Inflation risk and interest rates. Here's where things get tricky. Bonds and inflation have a love-hate relationship. When inflation rises, it erodes the value of fixed interest payments. Interest rate hikes follow inflation, which hurts existing bond prices. That's why long-term bonds can be risky in a high inflation environment. One way to counter this: Treasury inflation-protected securities, TIPS. These bonds adjust with inflation, protecting your purchasing power. 10. Conclusion. Here's how you use bonds the smart way. Saving for something big, like a house deposit. Stick with short-term government bonds, high-yield savings accounts, or fixed-term deposits. You want your capital intact and accessible within a few years. No gambling with riskier assets. Can't stomach wild portfolio swings. If you have a low-risk tolerance, injecting bonds into your portfolio can smooth out volatility while still allowing you to participate in riskier assets like stocks. Need stability? Government and investment-grade corporate bonds provide steady income and capital protection. Want higher returns and can handle risk? High-yield bonds offer bigger payouts, but come with more volatility. Parking cash? Compare short-term treasury notes, high-yield savings accounts, and fixed-term deposits. See what gives the best return without locking up your money too long. Want flexibility? Ladder your bond maturities. This way, you have cash becoming available at regular intervals instead of tying everything up at once. Worried about inflation? TIPS, Treasury inflation-protected securities, help protect your purchasing power. Wealth isn't just about making money. It's about positioning yourself wisely. Bonds are one of the most underused tools for keeping your portfolio strong, balanced, and ready for any market condition. If this breakdown helped, hit like and subscribe for more no-nonsense investing insights. Got questions about bonds? Drop them in the comments, and I'll do my best to answer. Are you ready to join us on this journey? Are you ready to win? If you're enjoying this content, show some love, hit the like button, and give it a thumbs up.